All right, so I'm really happy to be here. I've never been to this conference before, and thank you so much for inviting me. So I just want to start out by saying this is a great paper. My understanding is it's revised and resubmitted at the JPE, and it deserves to be. And I'm going to make some comments about the paper, but I want to talk about, in general, the problems that we're facing with this type of industry. When we think about protecting people in the market, some natural forces, come to mind. So the first thing is a free markets approach. And so if we can make things really competitive, then the industry will sort of cleanse itself and work things out, and firms will police themselves, and you'll kind of clear a lot of misconduct. Another is, firm reputation. And so if firms are known to do bad things to people, then people won't go to them, and so there'll be incentives to be clean. And at an employee level, same thing happens. If you're known or identified to do something bad, you get a bad reputation, you want to avoid this, and so forth. And therefore there'll be, less bad behavior, and then we can think about regulation. Now, with each of these things, there's really problems. And so, competition is probably not going to be something that's going to help solve the situation. And there's both theoretical and empirical work on this, and it really does come down to the fact that there are people who are unsophisticated, who are participating in these markets, who don't check everything, they don't understand pricing, they don't understand things. And so as competition grows and the chances of getting business from sophisticated people goes down, firms actually have higher incentives to dumb down the population or act badly and so forth. And so, we do see a very competitive industry, but yet we still see a lot of misconduct. And so competition isn't necessarily going to work. Now, the reputation channel is going to require some sort of signal about quality, and it's going to require a salient signal. And we'll kind of get into this in a little bit. But the thing is that most consumers are not discriminating, and they don't inspect public records. And so even thinking about your own, choices, I mean, you get insurance, you get mortgages, you have a real estate broker. I mean, when was the last time you actually searched out to see if any of them had violated anything? I mean, even as a group of experts, we don't do this. And so, it's hard to think that consumers are going to do this as well. And so making things more salient in the environment of making choice is going to be important. And then, of course, you have regulation, and we have the Consumer Financial Protection Bureau, which was established a number of years ago. I'll talk a little bit about that. But again, there's a limited capacity to seeking out people who have done wrong, punishing them, and so forth, and regulation may be limited. Now, what the authors document in this paper, it's sobering. Okay, and so Gregor did a great job. I mean, it's very prevalent. I mean, 1 in 13 people have some degree of misconduct. The misconduct is persistent. I mean, you get a lot of repeat offenders, and the misconduct is tolerated. And I think Gregor, in some ways, is emphasizing the fact that I think that it goes underpunished by the labor markets. And I'll give you some data from their paper in a minute. The labor market is an incomplete discipline mechanism in the advice markets. Yes, misconduct does lead to some exit and some lower future pay, but a large fraction of people remain and get recycled. And so even in a table, and this is one of the robustness checks that they did, we can sort of argue about what's misconduct and if there's a little complaint here, a little complaint there. I mean, if you look at severe misconduct, fraud, forgery, things like this, if you look at that subsample, you still see that over half of the people remain with their firm after doing this. And then, then when you displace, 44%, more than half of these people, or around half of these people are going to join another firm within a year. And so this is severe. These are severe things that they're doing. And I think we can agree that in some sense the financial industry is not policing itself through this labor channel. Now, one of the other things that is in the paper is that, Gregor showed you this table on the left, and it lists out the firms that do, the worst, they have the most misconduct. Well, then there's a table which says, well, which of the firms that actually are doing the best for their customers, or have the least misconduct. Well, you'll see that Wells Fargo's listed number 3 as the highest percentage, but it's also listed as number 9 as the best. But these are two divisions of the same company. The one on the left is the retail division. The one on the right is more institutional. And so even the same firm is dealing with customers or clients in different ways. And so I think this underscores the fact that consumers do need to be protected in these, and firms know that they need to be protected, and that they can prey upon them. That's for sure. Now, if we look at the last number of years, the Consumer Financial Protection Bureau was instituted, and we can see, we can wonder, have the regulators been successful in decreasing misconduct? Now, certainly, this basically shows you that from 2010 to 2015, the number of public enforcement actions have increased. The number of CFPB employees have gone up. I mean, it's now getting quite large. The number of settlements have become, or basically the relief that's been awarded to consumers has grown substantially. And, in a lot of cases, these are uncontested. They file them and they get settlement. And so this has really grown. The question I have maybe for the authors that they can look into is, over their time series from 2005 to 2015, have we seen any change in the offenses? Has the CFPB been helpful in sort of making people more aware of this? And have repeat offenders changed in the time series? And I think that they're in a position to deal with that. Now, of course, we all can point to Elizabeth Warren and how unhappy she is about the situation that exists. Frankly, even as a California Republican, I think she's right. I think in a lot of situations, these are people who don't understand financial instruments, and that things need to change in order to prevent them from getting hurt. Now, what can we do? Well, one of the things is that we can have a more salient signal about the quality of the advisors. And one of the things that the authors sort of look at a bit is, what types of exams do they have to pass in order to be doing what they're doing. And what they document is that in certain segments of the advisor population, misconduct is more prevalent. And so what the authors might be able to do is dig in a little bit more and characterize the exams that they take more. 5, good, I'm fine. And look at what kind of misconduct is related to the exams, and perhaps this could be a salient signal to consumers about which advisor. Maybe they should be looking for an advisor with a particular exam, or perhaps this is the type of thing where there can be a recommendation that you shouldn't see an advisor unless they had a particular passed a particular exam. And so the question, is, do certain qualifications reduce repeats? Now, salience is really important for consumers. And so if we look at 2 recent class action lawsuits against Wells Fargo, we have the phony ghost accounts, which we all can sort of we know a lot about, where, extra accounts were opened without the consumer's knowledge. Okay, and then there's the overdraft fees case, where people would basically be making making withdrawals or would be making payments, and they would reorder them to the bank's advantage. And so they would basically, if they went out and bought 5 lattes and then a television, they would reorder it to have the television first and then the 5 lattes so that they would overdraw their account and get all these fees. Okay? So the first question is which of these things got more press in the general public? Well, it was the phony ghost accounts. People were horrified that this was happening. Which one actually damaged the consumers a lot more? Well, it's the latter. It's the overdraft fees. Okay? But consumers don't really understand. If you say to them, you were charged overdraft fees in an unfair way, people don't really know what that means. If you say to them, well, they opened up accounts without you knowing, they go, oh, that's horrible. Okay? But if we look at what the damages were, only $5 million were paid to consumers for the phony ghost accounts. Whereas if you look at the overdraft fees, in the case in California, over $200 million was paid to consumers. And so consumers should be more outraged about the overdraft case, but they don't understand it. It's not salient to them. And in fact, in the phony ghost accounts case, the people who should be most outraged are the shareholders, because the ghost accounts paid incentive compensation to employees that wasn't warranted, and the employees were basically taking home money in bonuses that hurt shareholders. But to my knowledge, that has not been filed as a lawsuit. Okay? But the key here is that salience is going to be really important. All right, the last thing I wanted to just say is that compensation is an issue. The authors do look at this a little bit. It does look like the way people are getting paid are leading to more or less misconduct. Not surprising, when there are more incentives that are being paid, there's more misconduct, so there's actually an incentive to missell. This potentially could be a further extension to what, maybe a future paper that they work on. How should we be compensating advisors to avoid misconduct? And so, I basically think that this is a fantastic paper. I mean, they have gone to great lengths to show that these things exist empirically, and I think more work like this needs to be done. Now, we like to think that finance is a good thing, and I think it is. I mean, strong financial institutions are going to drive economic growth, and we want to encourage households to participate. But then, of course, when you see something like this, which I don't think we are that shocked by, I think that we have to think of ourselves. We have to start thinking of ourselves, people who are in academia, as the thought leaders in trying to write this. And in many different career paths, like medicine and, like, for example, in accounting, you do have top organizations that will have academics weigh in on what are best practices. And perhaps we should be thinking about this. The AFA should be thinking about having a task force to do exactly this, to try to curb this. Because this is our profession, and when we teach students, it's kind of embarrassing that every day in the Wall Street Journal there's all this fraud and everything going on. And maybe we should consider doing this as a group. So thank you very much for the opportunity. Thanks, Gregor.